Hi, everyone. Testing. Hi, everyone. Welcome. My name is Chloe. I'm a senior account manager. And we also have Kevin Corbett here, who's our senior business development manager. We're part of the social purpose real estate team at VCIB. And today we'll be delving into innovative financing strategies for community land trusts. So who is Vancity Community Investment Bank? We are Canada's only values-driven bank. Our mandate is to use the tools of finance to drive immediate and lasting social and environmental change in our communities. We are a subsidiary of Vancity Credit Union, a financial cooperative with over 500,000 members. In 2019, we acquired CoPower, Canada's first sustainable investment platform and a leading provider of financing to clean energy and energy efficiency projects. VCIB is a member of the Global Alliance for Banking on Values and is also a proud B Corp, meeting rigorous standards of social and environmental performance, accountability, and transparency. We have 5 main principles of banking: social and environmental impact and sustainability. We are grounded in communities, serving the real economy and enabling new business models to meet the needs of people. Building strong relationships with borrowers is our top priority. We work tirelessly to understand and advocate for clients. We go the extra mile to structure solutions to support them. We are long-term, self-sustaining, and resilient to outside disruptions. And lastly, we are transparent and have inclusive governance. At VCIB, we provide financing for commercial real estate projects that drive social, economic, and environmental benefits in communities across Canada. Within social purpose real estate, we provide financing for affordable housing, green buildings, nonprofit and co-op housing, heritage buildings, arts, culture, and community spaces, and investor-owned and owner-occupied real estate. We offer different types of loans from construction, term, and acquisition financing, CMHC-insured loans, including land and bridge loans. We serve and support those that create affordable, sustainable, and purpose-driven businesses. These include nonprofits and charities, foundations, women and BIPOC-owned businesses, co-ops, B Corps, and social enterprises. We connect and provide financial solutions that businesses require, enabling them to grow, prosper, and foster change. VCIB is owned by one of Canada's largest financial cooperatives, Vancity Credit Union. Vancity provides a wide range of support to co-ops, land trusts, including technical advice, peer learning and mentoring, and of course, financial support. Partnering with community land trusts is one way we are delivering our mandate, which is to bring values-based banking to the rest of Canada. VCIB has worked with several land trusts, which include Parkdale Community Land Trust, Circle Community Land Trust, Ottawa Community Land Trust, Kensington Community Land Trust, and USDC at Lancaster, also known as Union Co-op. VCIB is partnered with Canadian Network of Community Land Trusts, CHF Canada, and lastly, CMHC. 2 years ago, VCIB and CMHC announced its first-of-a-kind agreement to accelerate the delivery of affordable housing across Canada, providing financing for more than 1,100 units of affordable homes. VCIB's long-standing relationship with CMHC enables us to work together to provide housing cooperatives and affordable housing developers with uniquely structured loans that meet their specific financing needs. Land trusts often face their own financing hurdles, such as accessing financing fast enough to be able to quickly react to a competitive housing market. The needs of a land trust typically include large capital expenditures, deferred maintenance and repairs, deployment of excess cash, and housing of reserve funds. Since land trusts are often searching for smaller and more flexible loans, they struggle to get support from big banks, as it can be a lot of work for lenders. But that is where VCIB comes into play. Although we are a small and nimble team, we do not shy away from putting that extra effort into structuring loans to suit the financing needs of land trust. Community land trusts are a key part of our strategy to preserve existing affordable rental units. With the help of VCIB and new land trust organizations now emerging, this is one of many solutions to support the preservation of market and below-market rental housing that would otherwise be redeveloped into market or luxury real estate. So what are the benefits with partnering with VCIB? It's our competitive terms that are catered to land trusts. These include our preferred debt service ratio. This is determined if you have a capacity to make payments on a loan or mortgage. It is calculated by dividing your monthly debt by your monthly income. VCIB's minimum debt service coverage ratio is typically less for nonprofits and land trusts as opposed to for-profit organizations. Our minimum debt service is 1 times. Also, our preferred loan-to-value ratio. This is used to determine the maximum amount of a secured loan based on the market value of the asset pledged as collateral. It is calculated by taking the loan amount and dividing it by the value of the asset or collateral being borrowed against. For example, depending on the deal, if the loan-to-value is determined to be 50% or less, a formal appraisal may not be necessary or may be waived, which can save a land trust a lot of money. And third is our preferred fees and interest rates. We typically charge less for nonprofits and land trusts as opposed to for-profit organizations. We are a multifaceted full-service team providing real estate financing, business banking, and deposits. Lastly, we are flexible. We are more flexible than the big banks and have the ability to structure loans to suit a land trust's financing needs. So with the needs of a land trust, VCIB provides term financing, which is best for big-ticket items or where large repair backlogs exist. It's provided by single or multiple advances of funds. It is repaid over time, either 25 or 30-year amortization, and up to 50-year amortization with CMHC, MLI Select. Another common option is our line of credit, real estate secured, best for loosely defined programs of repairs and capital expenditures. It's provided in multiple advances of funds, and it's flexible on drawdown and repayment terms. What are the required documents needed for financing? We typically ask for the last 3 years of financial statements, together with year-to-date balance sheets, operating statements, and projections. Third-party reports such as building condition assessment, appraisals, and environmentals. Again, VCIB can be flexible with needing third-party reports. Depending on the zoning and residential neighborhood, an ESA may not be necessary, or depending on the condition of the building, a BCA may not be necessary. Again, these factors are all considered on a deal-by-deal basis. We also offer our business visa, which is best for daily expenses, travel and other rewards, and 10 cents from each transaction will go towards VCIB's shared interest fund to support Canada's communities. With that, I'll pass it along to Kevin to talk about some case studies.
Okay. Thank you, Chloe. Yeah, so now that you have an idea of who we are, what we do, we thought it would be best to highlight a few of our clients in action. I know that there was just a presentation for Parkdale Land Trust in the back corner there, so some of this might seem a little familiar. But as you know, Parkdale Land Trust is a grassroots community-based land trust with a focus on protecting the affordable rental stock in the gentrifying neighborhood of Parkdale in Toronto, which is just west of the downtown core. With the help of VCIB's Preserve and Protect Guarantee program launched in October 2020, Parkdale was able to acquire an at-risk residential building of 36 units on Maynard Avenue. By pledging cash collateral, the Preserve and Protect Guarantee enabled the land trust to bridge the equity gap, which helped Parkdale to acquire the building while earning a preferred interest rate return on their cash collateral. Additionally, because that worked so well, we were able to provide them in April 2022 acquisition financing for portfolio of affordable housing in the same community, 153 units over 81 properties, originally owned by the City of Toronto, and the Toronto Community Housing Corporation. Once everything was stabilized, Parkdale Land Trust partnered with YWCA to offer affordable housing opportunities for their existing tenants and women-led facilities. So the unique thing about this transaction was Parkdale was willing to put up a certain amount of cash collateral, and we were able to lend against that in addition to providing them a loan on the property they were looking to acquire. So when it came down to it, I believe in total it was like 115% loan to value, 75% against the property they're looking to buy, and then a direct security against their cash asset. And this worked out well for them because it gave them the flexibility to hold on to that cash, close on the property, and then take out our financing at a later date, either through other CMHC financing or maybe a conventional loan if the rents came up, I don't know, and then hold on to that cash, earn a return on it, and then apply that to the next acquisition. Because the main thing about land trust, as you guys know, is that you do typically buy the real estate asset in the open market. And so you need to be responsive, you need to have the cash available, and that's what this Preserve and Protect Guarantee Program enabled them to do. And we could talk about that more at the Q&A section. Next is Circle Community Land Trust, another Toronto-based land trust. CCLT acquired a portfolio of affordable housing that was owned by Toronto Community Housing in June 2022. The portfolio consists of 607 units spread over 561 properties, mainly single-family homes and duplexes and triplexes, situated across Toronto and Eastern Toronto, as you can see there. These assets were acquired over stages every month, and from about, I think it was June to October, about 80 to 100 per month. The properties were leased to tenants with a mix of rent geared to income, so they paid what they could, and then it was topped up by the city to 90% of market, or other tenants who were paying just market, but it was a reduced market at 90% of actual market rents. VCIB was able to provide a first mortgage financing for the acquisition, and the borrower utilized CMHC and a co-investment fund and other government funding for the subsequent renovations after the acquisition was done. So the unique thing about this transaction is obviously the geographic diversity and the sheer number of properties. Those are all individual title searches. Those are all individual, we didn't need individual appraisals for every one of these. You can look at it and then you can kind of, make the assessment on your own. Furthermore, they bought the assets from Toronto Community Housing for, I believe it worked out to like a few $1,000s per unit. And so a traditional bank would look at this and be like, well, yes, all these assets are probably worth $30 million, but you only bought them for $8 million, so we only do 75% loan to purchase price, we can give you $6 million. We were able to increase our leverage and kind of come outside of our operating guidelines because it's like, okay, yeah, they bought them for this amount, but we know what they're worth because, look at it, it's a ton of properties. Rational, malleable practice is kind of how we approach these opportunities because they're all unique. And so, so that's that one. Next is the Ottawa Community Land Trust, who's here today. In October 2023, the Ottawa Community Land Trust was able to purchase an at-risk affordable residential building of 6 units on Kirkwood Avenue to protect Ottawa's affordable rental stock. All units of the property were at an affordable rate of less than 70% average market rent at the time of acquisition, and they still are. With the help of VCIB's Preserve and Protect Guarantee Program, OCLT was able to purchase this, being their first building in the land trust, and this loan was paid out a year later through Tapestry Capital Bond Raise, and Tapestry's in the back corner. Shout out to Tapestry. With this, very similar to Parkdale, at least on a smaller scale, they had some deposits, which we were able to take security over, which means they were able to increase the leverage on their loan, and then over the next year, work through a Tapestry bond raise and pay us out entirely. So they were able to keep their cash asset on the books and then utilize that for their next transaction, which was earlier this month, where they purchased a second property of 10 units on Brant Street in Ottawa. All units here are at an affordable rental rate of less than 80% average market rent, and then utilizing the preserve and protect line as well enabled OCLT to bridge the equity gap while applying for CMHC certificate of insurance. So with this first building, they took out our loan with a bond raise, and for the second one, their plan is to use CMHC MLI Select. So really, we view our financing solutions as either it's the end result from a philanthropic acquisition, and then we can provide takeout financing for that, or we're taken out by a bond raise or by a CMHC loan. We also offer savings with an affordable housing high-interest savings account, which is high-interest savings account designed to help nonprofit affordable housing providers manage their savings and reserve funds in a safe and secure way. It's an open savings account, so you can take the money and inject money as you please. If you're interested in this, you reach out. I can provide you with a fully updated interest rate because it changes all the time based on the bond markets and the equity markets. This is exclusive to nonprofit affordable housing providers and is based on prime rate minus 1.85%. No management fees, fully liquid account, meaning you can access savings whenever you need. 100% of deposits contribute to the affordable and sustainable communities in Canada, and it's insured by the CDIC. Additionally, we offer impact GICs. They're a low-risk, non-concessionary vehicle for simple values-aligned investment and provide investors both fixed-term and cash-flow options. 100% of GICs help to finance impact projects in affordable housing, clean energy, and the growth of mission-driven organizations. Fixed terms from 30 days to 5 years, cash flow 1-year terms, minimum of $50,000 per depositor account, insured by CDIC, competitive rates, dedicated account manager. So for the examples of Ottawa Community Land Trust and Parkdale, they put their funds, I don't know if they put them into a GIC or a high-interest savings account, but they keep the funds with us, so we have visibility on them, and they earn these preferred interest rates, all while using that as security for them to build their portfolio. So it is a positive feedback loop when VCIB is helping every step of the way. Those are our rates. Again, you reach out to us and I can let you know what the updated rates are. But those are, again, preferred rates just for non-profit housing providers. I think that's our presentation. Thank you. And now we would welcome some questions from anyone.
We'll see. Okay, so yeah, who has some questions? I'll come around with the mics. Thank you so much, you guys, for the presentation. Really, really great. Don't be shy.
Do you have a representative in Nova Scotia?
We don't. So, again, for context, we are wholly owned by VCU, and our office is in Toronto, but we represent all of Canada. I travel wherever the clients are. So I'm your representative in Nova Scotia, even though we're based out of Toronto. Yeah.
When you're an ED, as long as Veronica, you don't need a mic. All right. Anybody else? Questions?
And if you're too shy to ask a question now, please come to our booth, reach out to us. Obviously, every deal we work on is unique, and so they might require a longer form conversation, which is sort of where I think we add value. We're a small team, and so you can come to us with like basic questions, and we're happy to field them anytime. It's what we like to do.
For sure. And there's a table at the back where they'll be all weekend, so if you want to chat more with them, you can do so there. Otherwise, if we have no... Oh, we have one from Hannah.
So I'm just wondering what lens you guys are taking on the risk of multi-use buildings. Like, it seems like all the examples, they were 100% residential. But I know for myself, the organization, we're looking to acquire commercial space, and most of the buildings that we look at are multi-use, so mixed commercial and residential. Like, are you guys amenable to financing that kind of stuff? And are you offering the same rates, or are you seeing that impulse of being very conservative about financing commercial real estate acquisition right now?
Yeah, so if you're a not-for-profit and you're buying anything, you are in our bailiwick. We can help you. So if you were buying an industrial building, we can help you. Not a lot of industrial opportunities in what we do, but I worked on an office transaction a year ago. A not-for-profit was buying an office building. So we do technically everything as long as it fulfills the impact lens. And so if you're buying a commercial space with retail frontage, it doesn't matter if there's a couple multi-residential units on top or whatever. If your company's mission is something that's going to better the planet, or you're a not-for-profit, or you're a charity, then we can take a look at that opportunity. And
how are you guys viewing kind of like co-ownership arrangements or like financing when maybe there's going to be multiple owners in a building? Because again, I'm dealing with a very unique situation where I can't fund residential use. Like if I encounter a multi-use opportunity, I'm going to need a partner. Right. So how are you guys dealing with those situations where you might have multiple title holders, or like some kind of condo stratification, like financing a scenario like that? I mean,
we could look at that. We would take security over the asset itself. Yeah. And if it's co-owned by you, maybe joint guarantees, we can find a flexible solution to get there. Usually the legal side of it doesn't hold up a transaction. Yeah. We look at it from a real estate perspective. Is the real estate good? Is their vision good? Is what they want to do with the property good? Is it sound? Then we find a way. And so we have a slate of lawyers that we work with, and we throw the kitchen sink at them in terms of new, nascent ownership structures. Because that's one of the most important things here, is that what you guys are doing is very new. I mean, it's old, it's been around for a long time, but it's really coming back into prominence. And so with that comes a lot of learning from our lawyer partners, and they rise to the challenge, and they find a way to make sure that we're secured from a risk perspective.
And so have you guys worked in partnerships where the other ownership entity has gotten their financing through a totally different channel? Or would you want to be the lender for both parties? Do you understand what I'm asking?
Yeah, I think we'd need to be the lender for both parties, and we'd be taking a first charge on the building in question. Yeah. If they, I mean, theoretically, if they came and they're like, hey, we've got financing for our half, and you came to us and we finance your half, you could theoretically do a pari passu syndication, where, let's say you're buying this thing for $5 million and you want $3 million of debt. We give 1.5. This other bank gives 1.5, and we're equal risk levels. Yeah. We could, theoretically. Yeah. 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 Yeah.
Okay. Thanks.
Yeah, no problem.
Thank you. Any other questions? All right, coming up to you, Sandy. Sandy from the Muskoka Community Land Trust. Let's go.
I know, we've spoken before.
We have.
We have. It's been a long time. I don't need to give you the update here. But at what point do you come in construction financing? Because what we found out, of course, that most people already knew, is that CMHC is like the long play. Yeah. That's the whole answer. When do you come in on construction financing?
Do you want me to? So, we pride ourselves on understanding your business, and also finding ways to make it work for you with the malleable structures. But when it comes down to it, there are some tenets of real estate finance that kind of have to be met, because in the end we need to make sure our depositors are protected. So when do we come in for construction financing? Like a traditional bank, let's say we're doing 75% loan to cost, all the cash equity or equity needs to be in, whether that's land lift or deferred costs or just cash, and all building permits need to be, it needs to be shovel ready. And then, so it's basically when you're ready to go. And that's sort of, because for construction, we can't really take on planning risk, because we do land financing, but that's sort of a different product, and that land money requires a higher yield. So yeah, the long and the short of it is when all your money's in and the planning is ready to go and you're ready to break ground, and theoretically you've probably already broken ground and incurred costs to get to that, the 25% you need to put in, and then we could start to have our money flow. Where we can help you though is we can make exceptions. So I said 25%, again, let's use that 75% loan to cost example, and so that means 25% equity. We can do things to help you where like a bank might not allow you to recognize the land lift on your property from your appraisal. We can make an exception and be like, okay, some of that equity is because they've owned the property for a long time, right? And so the land has gone up in value. It's not the cost that they're recording. Or deferred costs down the line. Or we can get a little bit more creative because in the end with doing that, it means that you're putting less cash equity in, which is the main constraint with what you're all doing. So the timing is the same as a traditional bank, but we can be more creative with making it work for you.
Thank you.
Thanks, Sandy. Anybody else have any questions? Yeah.
What about funding for something like if you wanted to do something that's not so much of a business, but it's like you purchase a piece of equipment or something and it does something, and then you're bringing in money that way to pay for, let's say, buying land or something like that?
We've wound down a lot of our kind of equipment finance business banking side because with the organizations we're targeting, it's less of a concern. They don't really have those sort of chattels. So we don't do equipment finance. That's sort of its own stream. But we can put you, I think VCU, I would assume they have, I can look into it for you, if the credit union, which owns us, if they have an equipment finance arm. And
like as an example, you just wanted to get some, let's say, have some servers or something, and then people will pay money to have those servers do or store or load whatever information it is that they want to the end user. So
that would be more on the
like that.
On the business lending side. We're specifically real estate lending.
Real estate only. Oh.
Yeah. No, but good question though, and I can put you in touch with someone from the credit union, and they might be able to help you. And they're based in BC, so. Yeah.
Thank you.
No problem.
Anybody else? We still got a bit of time left here, Yar.
All right, hi there.
Hi.
My question is about granting streams. Is there any element of this that is funded through a grant program versus this other financing streams?
Like we basically direct our mortgages, you mean. In terms of granting, talking like granting through the Vancity Foundation.
Yeah.
That's sort of a separate thing, but if there's an opportunity that the Vancity Foundation is providing funds towards, and there's a way that we can marry up our lending with the project that they're, we would count that as equity. And so yeah, and then also it's important because one thing I think that we like to think we specialize in, or we do specialize in, is understanding other grants from the city, from the province and from institutions, which a lot of banks don't view that as equity, or they're like, well, what if this funding gets pulled, or what if this, and we take time to understand it and understand the veracity of it, and if it will continue in the long run. A good example of that is the Mura program in Toronto, where they're providing $200,000 per suite to nonprofit housing providers. Some banks don't want to touch that. They're like, hey, you're not putting any skin in the game. You're using this grant. We're okay with that. That money goes in and that counts as their equity, and then we provide the balance in a first mortgage. So,
thank you.
No problem.
All right. Well, I think that it might be good to just end it here if there's not a whole bunch of questions and folks can come and have the one-on-one at the table.